over the past few years, I've started to think more about long-term wealth preservation and accumulation as it became more and more relevant coming off of the back of the last pandemic, where I started to learn more about inflation thanks to Mr. Michael Saylor. He really brought up actually a lot of things that I hadn't thought about before. In my opinion, up until that time, I always thought, oh, well, I'll just, if I need more money, I'll just make more money. Like, no problem, just trade more. Okay, that works, yes, but at the same time, it's good to be able to actually preserve your wealth and grow it as well, which is where long-term investing starts to really creep in. So I've been spending a lot of time learning about that in the past few years, and also practicing it myself. And for myself, unfortunately, I am not a wise person. I have to learn from my own mistakes, and as the old saying goes, a smart person learns from their own mistake. A wise person learns from the mistakes of others. So perhaps this can help someone else out there. And realistically, as this presentation does say in the bottom right-hand corner, these are realistically notes to self, things that I want to remember, that I've learned, kind of painful lessons sometimes that I've experienced in the past few years here. So let's get on with the first slide here and just talk about, assumptions and where this is coming from. I've been trading for over 15 years now. I've been watching markets for longer than that. I realistically started, I guess, when I was like 11 or 12, when I used to just watch markets with my father. He was a professional trader. I used to go down to the stock exchange with him and be his clerk at that time. And from there, just continued to become more and more interested in the overall space. And of course, in the past 5 years, I would say, is when I really started to study, long-term investing, and with a very heavy emphasis in the past 3 years, I would say. So these anecdotes are going to be coming from myself and also from other successful acquaintances that I've spoken to that have had either similar experiences or things that really made me think about what this is all about and how to make this for you. So I do want to say that this might not be true for everyone. This is mostly just experience here. So everyone's different, of course, but a lot of things are the same, I do find as well. Anyways, we're going to make an assumption here into the relevancy of this. It would assume that you have a base of wealth, and I don't want to say that from like a looking downs sort of perspective. But realistically, if you are going to make long-term investing work for yourself, I do think that you need some sort of base of initial wealth to grow and protect that makes it worthwhile. In other words, if you only have, let's say, you have $10 in your account, a very extreme example, you might compound that, over the next 50 years, and that's great, but, it's not going to be all that much. So I think that if you are starting off with maybe a lower amount, the better, more relevant thing to do, and again, this is a thing for you to decide, but in my opinion, the better, more relevant thing to do would be to go make more first before, really getting into investing, because you'll probably have more bang for buck there with your attention focused on that. Anyways, okay. Compounding works, in other words. It is indeed the eighth wonder of the world, as Mr. Warren Buffett says. But you must have a significant sum, as defined by yourself, first to make the most of this. Just kind of putting in words right there. If not, then it is better to focus on generating that initial equity before putting money to work in long-term investments. And I realized that my face is actually not blocking the words there. Nice. But long-term investment in this context is defined as anything held for over a year. The reason why I chose that definition is because that's how the tax authorities in the U.S. and I think most other countries as well define long-term capital gains, which has special tax advantages. So moving on from there, let's talk a little bit about the advantages of long-term investing. First off, you get to avoid short-term capital gains tax rate, which may or may not be a concern. Again, if you are earning a lot more, then it is probably going to be a much higher tax rate than what you would have compared to long-term capital gains rate, as you'll be taxed at your ordinary income of your individual tax bracket. So if you're at the top tax bracket in the U.S., that's about 37% right now, you'd be paying that on short-term capital gains. So any trade that you make open to close within less than a year. Now, if you go with the long-term capital gains tax rate, then it's maximum 20%, even if your individual income is within the 77, but the 37% tax bracket. And if you're in the 10 to 15 tax bracket, I mean, you literally pay zero on long-term cap gains rate. Then again, if that's you, maybe might want to focus on growing that portion first, and then kind of the sweet spot between 25 and 35% tax bracket for individuals, you only get taxed 15%, and that's not including other things that might even reduce it further. Anyways, other advantages are, of course, less micromanagement, more time to invest elsewhere. So you can almost not just compound your money through investing, but you can compound your skills through using that time that otherwise would have been on direct money making. You could invest your time into something else that might give returns in other ways. Maybe it's a more like spiritual endeavor. Maybe it's a whole nother business which will return more income as well. It could be anything. You might be investing in relationships. These sort of things are up to you, but it gives you more that extra time compared to trading on a more lower term time frame basis. And by the way, before I get this question, I still do trade. I still do lower time frames as well. But I, of course, naturally shift to this sort of style over time. Anyways, you can compound your gains. You can compound your gains not just with the skills, but also with literally the investments, and that is quite literally the eighth wonder of the world, where essentially in your investments you might be earning dividends, or you might just be taking profit on the gains and then reinvesting that. And if you do that on a yearly basis, that is going to add up, and it's going to create a much bigger snowball that is just gaining more and more momentum over time as it rolls into humongous massive avalanche. And in my experience, it's lower stress. It's lower stress with long-term investing because, well, you're not really, or at least you shouldn't be, looking at lower term timeframes, which is actually going to be one of our laws here. But it can be lower stress if you let it be lower stress, because realistically, if you're a long-term investor thinking a year or more out, you shouldn't be too concerned with a day's worth of fluctuation, not even a week's fluctuation or even a month fluctuation at that point. So less chart watching, basically. Anyways, the first law. Okay, when it comes to investing, this is the one that is the most important. The market cycle matters more than the damn asset that you're trading, okay? Yeah, every once in a while you will see a certain asset go moon mode, even in an overall bear market. It happens few and far between, but that is, in my experience, a very low probability, picker's game, and I don't think it's a reliable way to do things. I think the lower stress and more reliable and higher probability thing is to, well, pick a strong asset in a strong market. A rising tide lifts all ships. In other words, even your shit coins, even your doggy derp shit coins, go moon mode when the market is frothy. So what you can the way that I think of it is this: strong asset in a bear market, bad returns, or maybe suboptimal returns. Not going to be as good. Weak asset in a bull market, it's probably going to be acceptable, at least at minimum. And in many cases, we see dog shit things, go absolutely moon in a bull market. Just look at many of the cryptos that we've seen. And of course, a strong asset in a bull market, that's where the stars align. That's where we want to be. That's where we want to really be investing our capital. It might not be at the actual low, but ultimately, that's where the money's actually made. And of course, a weak asset in a bear market, fucking avoid it like the plague. It shouldn't even be a question. I always cringe when I see people, investing in the most garbage of shit coins at the bottom, in the beginning of a bear market, because it's low. There's no such thing as low. It can always go lower. Anyways, a strong asset in a down market will never be as good as a strong asset in an up market. It's just by definition. The strong assets lead and create the strong upside markets. That's why you see the Magnificent Seven in this past market cycle, go to the upside in extraordinary fashion first before everything else in the stock market kind of follows. And I think for the people who maybe haven't done this for as long, or maybe just are thinking in the wrong way, they think, oh, the Magnificent Seven, there's only 7 stocks that are going up. It's like, no, you expect the strong ones to go up first. That's why they're strong. That's why you invest in the strong ones, because they're more reliable and they're going to be the first ones to turn around. Duh. Think about it. Who's most likely to be the first ones to turn around when it goes from bear to bull? Is it going to be your weakest shitcoin asset? No, it's going to be your stronger assets, especially in the stock market. Strong assets will more often than not hold their own, or just don't go down as much pound for pound relative to, the index or just the weaker stocks in a bear market. I mean, that is just by definition. And I find it best to use the bull cycles to find which ones have the best potential, which ones, were strong during those times, and were leading the market. Those are usually going to be the ones that are going to survive and lead again. Of course, doesn't always work with crypto, because in crypto, like a lot of the times you'll just get new shit coins at the start of a news cycle, and then those can be super strong just because they don't have the same sort of overhang that other things have. So it's kind of a different game there, but it has to be new. It can't be the old ones. And then in my experience, if you are a long-term investor, you want to be waiting for the bear cycles to start to DCA. And in the bull cycles, obviously, to be taking profits. So the bull cycles are for taking profits and finding out which ones are the strong. And then the bear cycles, okay, if you like your strong ones, that's a time to do long-term investments. DCAing is actually not the worst idea in those, at least in my experience during those times. Anyways, moving on. Law 2. This one's going to ruffle some feathers. Don't diversify. Specialize. Spend time studying a particular asset and learn its history, both in price chart and fundamental format. Like, become one with that asset. Really study it. And repeat that process until you found something that you have conviction on based on the long-term trend supported by, yes, the fundamentals as well. If you are a long-term investor, you do want strong fundamentals. The problem with crypto specifically is that most things don't have fundamentals. This was actually more of an issue like in past cycles, 2018. Namely, of course, in the stock market, you actually do have fundamentals. You have price to earnings ratios. You have forward outlooks. You have earnings. You have all these sort of things that you can, look at. But anyways, that's the idea. You want good chart, good long-term chart. What do I mean by good long-term chart? I mean, it must be up throughout all market cycles and always have a higher macro low. That is the hallmark of a strong long-term macro chart. Like, we're talking monthly timeframes for traditional markets, especially. Fundamentals are a little bit more tricky. It's more subjective. There's many things to judge this part. So that really comes down to, your own preferences and what you're looking for. But those two things married together, those are what create the big winners in my experience in the bull markets. And our job is to find those, is to find those and then invest in them. In my experience, it's best to go in with the majority of my intended investment as well. Into a very limited amount of things. Realistically, no more than 3 to 5. Yeah, I know that's a very small amount, but most, especially in the stock market, and even in crypto as well, most of the market gains are driven by just a few things. Everything else are kind of like stragglers or just along for the ride, and they might have okay gains, but it's not anything super crazy. So the more concentrated. The more concentrated, the better, at least in my experience. And I really do mean that. Assuming, big caveat here, assuming that the above criteria is met. Good long-term chart, strong, great long-term chart. Monthly higher lows, macro higher lows, and then good fundamentals, whatever that might mean to you. Could I be wrong? Sure. But I'd rather cast one massive whale-sized net than cast out 1,000 shrimp-sized net and catch all the damn shrimps, but not catch any of the whales. That's the idea. At least that's my logic there. Law 3, big one for reducing stress and anxiety. Delete all your damn timeframes under 1 week time frame. I mean, if we're doing a minimum of just 1 year investment, there's no reason to be looking at anything under a weekly, because it's just not relevant towards that massive net of a time frame, and especially if you're thinking multiple years out. And I would even say that 1 year is not even that long. 5 to 10 years. Okay, now we're talking long-term investments, in my opinion. But I find it's really best to just avoid the noise, the news, the volatility of any time frame under 1 week. Just helps get rid of those emotions, and typically things pass quite fast anyways. And if you don't even see it show up on a weekly or even a monthly for that matter, it probably doesn't matter all that much. And this helps get rid of those emotions, basically, and the urge to do something against plan, because that's really where you get into trouble. Doing something that is against the overall plan. Logically, if you're investing for 1 year minimum, then there's no sense in using anything under a week, just because, think about it. There's 52 total bars within a year. And again, that's just 1 year. So there's plenty of time to make a decision within that time period. Really, that is what it comes down to. A reversal is not going to be had in 1 day. A reversal is not going to be had in 1 week. It's probably going to happen over the course of a month or two, realistically. Anyways, the next law, only spot and no leverage. Again, another one that I think might not go over too well, but with some people. But this is my experience, and I'll explain why. When taking on long-term investments, it's best to avoid using leverage. This is because leverage creates margin risk. And when you have margin risk, you have the potential to get liquidated, forcibly, I should say. And that is essentially multiplication by zero. Taking your investment and multiplying it by zero. And anything multiplied by zero is always zero. That is the problem with using margin for very long term. Because black swans might happen. And think about it this way. Black swans and white swans, to be fair, have a non-zero probability of happening. It's very low. It's very, very low. It's maybe like a 10 sigma event by definition, so very low probability. But if you are investing for the very long term, then you have a greater time horizon for where that very low probability event can happen. And well, as we've seen in the past 20 years, that's happened a couple times or a few times now. So realistically, I find that if you're going to be doing very long-term investments, don't use leverage, because that situation will inevitably be happening. And, you might be invested for 5-10 years, and you might have all these crazy gains that might get wiped out in 1 day, or you might get a margin call because just some random weird situation happened. If you're using only spot, that's not going to happen. You can't get liquidated. You can't get margin called when only using spot. In other words, using no leverage, not using money that you do not have to invest. And that can be done in many ways. Obviously, you might take on loans. You might run up credit cards. You might literally use leverage within the market. I would suggest doing none of this with long-term investments. Anyways. Moving on, mathematically, yes, we already went over that. Actually, I think we're good there. All right, let's move on to the next one. Law number 5, hold a core long position. I feel extremely strongly about this one. What do I mean by a core long position? I mean, always hold at least some of the asset, even if it's the nastiest, worst bear market of all time, long, not as in spot, not as in leveraged, by the way, which is technically a misnomer. But anyways, my rule is that I will always hold at least 10% of the asset that I am, investing in long term, no matter what. It doesn't matter what happens. I'll just hold it. It doesn't matter. I need that in my back pocket, 1, because I might be wrong about what's currently happening. And then 2, it's just, you never know. And it's always good to have that position, because actually also very important, it helps get rid of the FOMO emotion, where you feel like you might be missing out if things are going up again, technically against you, like you're not fully in, but you at least got some in. So you're participating in some of the upside if you're wrong. So it helps get rid of that. Or if you just have FOMO in general, you always think that things are just going to explode out of nowhere. Fair enough. You always at least have some position there, even if it's just 10%. That's okay. 10% is fine. But, and look, I will do this in the most extreme situations. Even if I believe the market has topped for years, I will still hold at least 10%. It protects me, again, it protects me in the event that I'm wrong, and also helps reduce FOMO. And that's really what it comes down to. You're always participating in the upside of the asset, even if the upside is not occurring. All right. And then law number 6. So this one's also rather important. Meditate on imperfection. So here's the thing. If I or you are using a weekly or higher than that time frame, like a bi-weekly, a monthly, etc., to manage long-term investments, it is inevitable that I'm not going to be perfect in my entry nor in my exit. It's not going to be the ultimate high nor the ultimate low, nor do you need to invest at the ultimate low or sell the ultimate top to make very, very good amounts of money. What is more realistic when using these higher time frames is that I'm going to be able to identify a reversal maybe 10 to 20% off of the high or off of the low. That's where you typically see your lower highs or higher lows come in around. And that is the first signal of long-term reversal on a time frame like that. So think about what that's going to be like. I mean, if you're trading Bitcoin, and let's say you really believe that Bitcoin is going to 1 million, for example. I don't think it is, but let's just say, for example's sake, maybe it goes to 1 million, but I'm waiting for that weekly lower high to get out and tell me that the trend has reversed. Well, okay, let's say the plan goes literally perfectly to plan. The plan goes to plan. It goes literally perfectly to plan. And so Bitcoin goes to 1 million, and then it starts to reverse. We get our lower high at 900,000 or 800,000. I want to think about what that's going to look like in terms of price. I want to think about what that's going to look like in terms of my account equity value, seeing it go from X amount to X amount minus 10 or 20%, and then realizing that, this is fine. Like, I'm not losing that money. This is by definition. This is by plan, and I need to go by that plan because, hey, look, if it goes to 1 million, why doesn't it go to like 1.5 million? And then, I sell on the lower high there, and it's maybe that's like 1.3 million. And then you get out that, that's, in my opinion, the better way to do things, because you can't guarantee a price. You can guarantee a plan, though, but you can't guarantee a price. The market is only going to give you what the market gives you. And if you, let's say you said, I will only sell Bitcoin when it gets to 100,000, and it gets all the way up to 99,000, like 99,999, just for an extreme example, and then you don't sell. Or it gets up to 95,000, which is probably more realistic, or 90,000, and then it turns around. And then you're like, well, I'm only going to hold until I'm only going to sell at 100,000. Well, you're going to lose out on fucking everything if it does reverse there and it never goes back up again. That is a legitimate possibility. So what's the best thing to do? In my experience, go with the weekly trend. Go with the monthly trend, whatever time frame is most relevant to your sort of investment horizon. And understand that that's not going to be perfect. It's going to be less than what your all-time high portfolio value was. That is just what it's going to be. And when you're looking to buy, understand it's probably not going to be on the exact low. Or if you are DCing it, maybe get a little bit on the low. Maybe get a little bit on the low. Depends on what you're going to use there. You could use DCA, or you could wait for higher low. Fair enough. Okay. And again, I really spend time visualizing this of what it's going to feel like in the moment, because I know myself, I'm going to have that temptation to get back what was mine. I had X amount in my portfolio value at the all-time high. I'm getting that back because it's not worth less. That was taken away from me. It's no, it's not yours anymore. It's not yours anymore. And that's fine. That's okay. Anyways, moving on now. Law number 7, be prepared to wait. And fucking figured out something to do during that waiting portion. Study the asset at hand and identify how long the market cycles take on average, as well as the worst case scenarios and the best case scenarios as well, to be fair. And ask yourself, can I reasonably wait this long? Can you? I can't answer that question for you, but I ask myself this question, can I wait 5 years? Okay, what does that actually feel like? What does it actually look like? Do I need that money? Or are there situations that could arise that make me need that money? I mean, if the answer is no, then you have a really big vulnerability. That is basically the same as taking on leverage, because the biggest position of power in long-term investing is being able to wait. I mean, the best investors are the people who just, they bought something and they died, so they're technically holding for forever. Those are the best investors by returns, by the way. And if you either cannot wait or need the liquid cash for whatever reason, then it is possible you get caught in a bad situation. Any sort of random things can arise, medical bill, shit like that. And you might have to liquidate your holdings, thus destroying the overall plan. In other words, think of your invested cash as dead to you. It does not exist as long as it is in the market. It's not there. You threw it into a black hole, and then maybe that black hole comes back around, years later. And then number 8, in terms of entry and exit, and this isn't exact right here. I mean, like I said, you can do it on trend changes as well, but enter in a bear market and exit in a bull. When handling very long-term positions, ideally, I want to only DCA into positions when the market is in an overall downtrend. If you are using unleveraged positions, then you have the advantage of being able to wait longer, because you're not going to get margin called if and when things go further south, because very likely, you don't know when they're going to fully turn around. I mean, no one really can know where the low is before it happens. You can have statistical models that tell you where it's maybe likely to happen, these sort of things, but you don't have certainty. And until you really get that actual reversal, it's all kind of up in the air. So think about how often will you DCA, how much percent will you DCA per period. These sort of questions obviously are preference, so only you can answer those for yourself. Or if you would rather do it, off of a trend change, reversal. Does the weekly start to put in higher highs and higher lows? Okay, maybe go in there. Again, realize that you're probably gonna be like 10, maybe even 20% off of the lows. Okay, that's fine. Again, there's not a right or wrong way to do it. I think both of these ways can be completely fine. DCA, I think, is like the more easy on the soul method, though. Obviously, on the other side, when selling, I find it's best to basically DCA out in your sells. Sell in tranches throughout a bull market. You don't need to catch the ultimate high, but take profit along the way. You can reinvest that as well, and that just compounds your gains even more, which produces more gains later. Especially if you're just very set on holding for a very, 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 very long time. I think that's actually a very viable way to do things, and something that I prefer to do myself if I can. So that brings us to the end of our presentation here. Again, this is not to say that this is like the best investing guide of all this, of all time. These are just lessons that I've learned myself that I feel very strongly about. That I find were very. Some of them were painful to learn. Some of them were very helpful and very valuable. So hopefully this can serve you in some way. And I'll leave things off right there. And I'll see you in the next one. Take care.